Could today's U.S. election be the start of a market shakeup? How have stocks historically reacted post-election? And what can we expect this time? And will the Federal Reserve's rate decision add fuel to the fire? Welcome to The Daily Show, where we take a look at the latest economic news, market data, and stock market updates. This week is all about the U.S. election, so let's dive into what it could mean for your investments, first with some brief economic news. A new study from the National Retail Federation warns that Donald Trump's proposed tariffs could cost U.S. consumers a whopping $78 billion annually. The tariffs would impact everyday items like clothing, toys, and furniture, areas where China is a primary supplier. NRF's Jonathan Gold noted that retailers rely heavily on imported products to keep prices low. Higher tariffs would especially burden low-income families, as import costs often get passed to consumers, raising prices across the board. The Reserve Bank of Australia held rates steady at 4.35% today, signaling no relief for borrowers this holiday season. While inflation has eased, underlying inflation remains sticky, meaning rate cuts aren't likely until at least mid-next year. The RBA's hawkish stance diverges from other central banks, like the Fed and ECB, which have cut rates. Governor Michelle Bullock stated the RBA is staying vigilant on inflation risks. New Zealand's central bank offered a bleak economic outlook, citing rising unemployment and delayed business investments. The RBNZ's financial stability report highlighted increased financial stress among households and ongoing cost pressures for businesses, with the economy likely contracting in Q3. Despite these challenges, the bank assured that New Zealand's financial system remains resilient, with banks prepared to manage any rise in non-performing loans. In China, the Caixin Services PMI hit a three-month high, jumping to 52.0 in October. This uptick suggests that Beijing's recent stimulus measures are starting to boost business conditions. Service providers have begun hiring, and confidence is at its highest in 5 months. However, new business from abroad saw a slight dip, and cost pressures remain a challenge. Economists say sustained consumer demand is crucial for China to hit its growth targets in 2024. Now let's dive into how stocks typically behave around U.S. elections. Historically, stocks have had a remarkable run in the year following the election. Looking at the last 10 U.S. elections, the S&P 500 was higher a year later 9 out of 10 times, with an average gain of 15.2% and a median of 17.2%. Even in the shorter term, we've seen solid gains. The average return 1 month post-election is 1.4%, 3 months is 6.8%, and 6 months clocks in at 7%. So, while politics can feel chaotic, historically, elections have set a positive narrative for the market in the months following as political uncertainty diminishes. Speaking of post-election moves, it's interesting to note that price momentum usually continues into the weeks after an election. According to data, the direction of the S&P 500 on the day after an election has been mirrored in the 2-week return 100% of the time over the last 7 elections. Keep a close eye on how stocks perform the day after the election to set your strategy for the following weeks. Now, let's look at what Bank of America's models are signaling. The CTAs, or commodity trading advisors, will send a selling signal if the S&P drops below 5642 and the Nasdaq below 19187. If markets continue to slide, gamma could become more negative and amplify selling pressure. Remember from yesterday's episode that we expect high volatility today with the U.S. election, but in 19 out of 20 election days, the S&P has seen gains. Q3 earnings have been strong, with 72% of companies reporting so far, showing 14% year-over-year growth. On another note, the U.S. deficit has hit a historic high under Biden's administration, at minus 7.3% of GDP, the largest since World War II. This trend of fiscal expansion began in the Obama era and has continued through recent administrations. High deficits contribute to inflationary pressures, and with both Trump and Harris indicating a lack of fiscal discipline, we could see inflation come roaring back. Warren Buffett's holding company, Berkshire Hathaway, has surprised investors with recent moves. They're making waves by amassing a record $325 billion in cash, after selling about 25% of their Apple shares over the summer. Berkshire's risk-off mindset, selling $36.1 billion in stocks overall and making no buybacks for the first time since 2018, raises questions. Is Buffett cautious about valuations or preparing for an economic downturn? As he famously says, "Be fearful when others are greedy." Finally, we're seeing a contrarian signal as cash levels in global funds drop to 3.9%, often a precursor to market corrections. Given Berkshire's cautious moves and this signal, one has to wonder, are we being too optimistic? On Wall Street, markets ended Monday slightly in the red as investors brace for both Election Day and the Fed's upcoming policy decision. The Dow led the declines, down 0.61%, with the S&P 500 slipping 0.28% and the Nasdaq down 0.33%. In contrast, the Russell 2000 showed significant resilience, ticking up 0.38%, benefiting from the drop in Treasury yields. The U.S. 10-year Treasury yield saw a notable retreat, down more than 2% to around 4.3%. This yield dip reflects cautious optimism among investors hoping for a clear election outcome to stabilize market sentiment. Energy stocks topped the S&P sectors, boosted by rising oil prices as OPEC Plus delayed its output increase. However, it was a mixed bag across the board. Chip giant Nvidia gained after news that it will replace Intel in the Dow, but Intel itself slid, weighing on the Dow's performance. The Fear and Greed Index has dropped into fear territory, now sitting at 43, down significantly from 57 last week when it was in greed. This shift suggests rising caution among investors as they pull back amidst market uncertainty, especially given the U.S. election and the Fed interest rate decision. In sector performance, solar led the pack again, gaining over 3%, followed by energy and clean energy sectors. In the last 5 sessions, solar has accumulated a 3% gain, so congratulations to anyone who is in this trade. On the downside, utilities and financials lagged, with utilities losing over 1%. Crude oil spiked 2.85% after OPEC Plus delayed its output increase, and it is now trading at $71.47 per barrel. Meanwhile, natural gas surged 4.43% to $2.781. Gold, however, remained steady, edging down slightly by 0.11% to $2,746. Tuesday doesn't have many economic events. We will get the ISM Services PMI at 10 a.m. Eastern Time, but the U.S. presidential election will dominate discussions today and in the coming days. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you tomorrow.